Okay, thank you all. I promised to stay on schedule and wrap up by 4:30, but the amount of information that we have here is enough for an entire semester in college. So I'm just going to give you a very high-level overview of what's going on with the GAAP financial reporting. As Lori mentioned, my name is Joe Evans, partner with RSM. We're the fifth largest accounting firm, and we do lots of governmental audits, so we're very familiar with the reporting requirements. And I am also the engagement partner on the Indiana Public Employees Retirement System, INPERS, which many of you are probably members of. You may have received a visit from one of our auditors testing your payroll records, so I apologize if you had to go through that. But anyway, if questions do come up, my contact information is included in the packet, joseph.evans@rsmus.com. And also, we have set up a separate website, HEA1009@rsmus.com. So to get into the meat and potatoes here, we want to talk a little bit about HEA 1009, which is the new law that's requiring GAAP financial statements. I'll talk a little bit about current accounting practices, explain GAAP for governments, talk a little bit about full accrual reporting, and then the back of the section, the back of the handouts includes step-by-step preparation instructions on how to prepare a full accrual financial report. I'm not going to get into all of those details, but I thought I'd leave the slides together so that if you want to take a look at it later or you need a guide, this could be a good way to do that. As was mentioned earlier, the GASB enacted statement number 34 requiring full accrual accounting almost 20 years ago. So it was back in 1999 that the GASB first put out this rule. So I feel like this is kind of like back to the future. So some of us had prepared GAAP financial statements years ago, got away from it, and now we're getting back into preparing GAAP financials. So if you've been through it before, at least you have some background. But the downside of this is over the past 20 years, there have been another 50 or so GASB pronouncements that have been enacted since GASB 34. So when GASB 34 came out back in 1999, since then, we're up to GASB 90. So as of today, they're on 90, and the GASB's been busy, so they're going to be working on even more. But just to summarize the law, House Enrolled Act 1009, it requires full GAAP financial statements. And what the law says is if you're going to issue bonds, that you have to have a full GAAP set of financial statements. So the cutoff dates, August of 2020 for schools and June 30, 2020 for counties and municipalities. If you're going to be issuing debt after those dates, you have to have a report that's prepared in full compliance with the GAAP reporting model. The State Board of Accounts issued a directive 2016-1, which explained the new law and explained the requirements. And just to put things in perspective, the State Board clarified the requirements, and they are really responsible for the financial reporting throughout the state. So, they issued this directive to clarify that, yes, in fact, this is what everyone has to. Okay, so let's talk a little bit about the benefits of the full GAAP approach. Other than more work for you, the cash basis alone really does not measure performance. So, you can have a situation where you're holding bills at the end of the year and your cash balance looks really good, but the reality is your financial position is no better because you're just holding the bills, you're not paying them. So things like that enabled you to manipulate the financial position will not be available under the full gap approach. The other thing about the full gap approach is it not only measures short-term compliance, but long-term compliance. So it's a measure of your comparison to budget, how you spent your money on a short-term basis, your cash balances, but it also accounts for your long-term economic resources. So things like capital assets that were talked about earlier, accounting for restrictions. It provides a complete picture of what the government is doing, and this is something that the investors or the people who buy your debt, the bondholders, this is something that they're looking to receive. So the information that we're providing is stuff that people have been asking for a number of years, and many other governments are already reporting under the full gap method. This has been around, as I mentioned, almost 20 years now. Component units will need to be addressed. I'm going to talk a little bit about what a component unit is and what we need to do to test for them. The full gap approach is more transparent. It includes all of the information that's needed for both the citizens and the investors within one report. So, some conversion issues, some things to think about. We may need to change how we capture our data. So if you are currently following the guidance that's been provided by the State Board in terms of your fund structure and your chart of accounts, you're 95% there, because that is the information that will be needed to roll up into the GAAP financial statements. But if you're not following that chart of accounts, or if you have deviations from it, that could impact how the information rolls up. It may require system changes. So, right now we're very good at capturing cash basis data, but at the end of the period, we may need to have a separate fund or a separate reconciliation. Some people call it a 13th period close, where we actually record all of the adjustments to go from cash basis to modified accrual, and then from modified accrual to full accrual. So if our systems are not capable of doing that, we may need to take a hard look at those systems. There was a comment made earlier that over the years, with all the accounting changes that have been made, no one has ever brought on new personnel to do this. So hopefully, our systems are going to be where they need to be, and we'll be able to get enough help to make sure we can accumulate the data and report accordingly. Fixed assets. There were quite a few comments earlier about the procedures to accumulate fixed assets, and as important as that is, that's only the tip of the iceberg. We talked at length about all of the detail that needs to go into the fixed asset records. Mike Nielsen talked about accumulating historical data, data on infrastructure assets, and all kinds of assets throughout the organization, establishing proper thresholds. All of that is going to be necessary under the new financial reporting model. So now I'm going to talk a little bit about governmental GAAP. Generally accepted accounting principles for governmental accounting. As I mentioned, this is a whole semester at your local university. But what does this actually entail? Okay, so we have a full accrual set of financial statements is going to have MD&A. So MD&A is management's discussion and analysis. This is a whole write-up of information about the entity, about where your revenues have increased and decreased from the prior year, where your expenses have changed, comments on major fixed asset additions, anything that would be interested to an investor involving the finances of the organization is really talked about in the MD&A. The first time you go through this, it's really going to be a challenge because you'll need to think about the types of changes, the types of information that an investor would want to have. Now, there's samples that can be obtained about other governments who've done MD&A. There's a prescribed format that's available from the Governmental Accounting Standards Board. So there's lots of resources available as to how to get there, but it's going to be a lot of work to make sure it happens. We have something called the modified accrual fund statements. So we start out with the full accrual fund statements. Then there's the modified accrual fund statements. Well, full accrual includes fixed assets, debt, all your liabilities. Modified accrual is closer to cash basis, but not really. So modified accrual includes things like utility bills and payables and certain receivables, things that will be received on a short-term basis, but it doesn't include long-term debt and permanent capital assets. So we already have two sets of books here, two sets of financial statements. We have the full accrual, we have the modified accrual, and if you're keeping your books on a budgetary basis, you might have a third set of financial records. So the GAAP financial statements requires that these different bases be reconciled within the statements themselves. So we have something called the reconciliation of the two perspectives, which is the full accrual versus the modified accrual. Something else that's new is a statement of cash flows. So to the extent we have proprietary funds, which are business type activities, we have to have a cash flow statement. Again, another very complex statement that looks at all the various receipts and disbursements by category. We have to have a full set of footnotes. So the footnotes talk about the accounting policies, the changes in fixed assets, the debt. Again, there's suggested formats for how the footnotes should look. Required supplementary information is something that will need to be added to the financial report. Required supplementary information includes a budget to actual detail schedule, which shows the original budget, the final amended budget, the actual results, and then a variance column. Additional required supplementary information includes any pension information. So to the extent you are part of INPERS, they will be providing disclosures to you relating to that particular pension obligation. But some of you may have your own plan. There's a number of counties that have a sheriff's plan, for instance. That's your own individual plan, and you'll need to have your own actuarial valuation done in accordance with the standards, and disclosures of the funding progress of that plan will also need to be made. Everybody still with me? Individual fund disclosures are optional but recommended. So many of you have, lots of different funds, and the detail of those would typically go in the back of the report. And then stuff like receivables, payables, fixed assets, infrastructure, as was mentioned earlier, all of that needs to be included. So the reporting entity, we use this concept in governmental accounting to define what we are actually reporting on. And so each county is considered a primary government, so they are the main reporting entity. So you have to report your governmental activities and your business type activities and any component units. Well, component units are where it gets a little complicated, because a component unit is an unrelated organization that needs to be pulled into your financial statements and reported. And so I'm going to talk in a little bit detail about component units in a minute here. Another thing to think about is the number of funds. And although the state board has recommended a number of funds, the GASB talks about, they have this concept of having the minimum number of funds that are required. So they want you to maintain the minimum number of funds that are consistent with legal and operating requirements. So what does that really mean? Well, let's say you're a county with hundreds of drainage districts, and all of those are very similar funds, and they all have to be set up separately because of either a tax levy or a legal requirement. But when it comes to your financial reporting, those type of funds we're going to collapse into one fund. So we're going to need to take a look at how our funds are structured, particularly with respect to debt, capital, drainage, maybe donations. Take a look at those funds, and to the extent they are very similar, for reporting purposes, we may want to combine those funds into, combine the smaller funds into larger funds for purposes of reporting. As far as the fund types go, there's three basic fund types: governmental, proprietary, and fiduciary. The governmental funds includes our general revenue fund, which is the general operations of the county. Any special revenue funds. So special revenue funds are set up individually for for dedicated revenue sources. So typically, if you have a revenue source with restrictions, then it would go into a special revenue fund. A lot of times your grants will be set up in special revenue funds. Capital projects, to the extent you have monies that are set aside for specific capital projects, those would go into capital project funds. Debt service, same type of thing. This is accounting for the principal and interest payments on any debt service obligations you have. Permanent funds in the government area, we typically don't see a lot of these, but this is where the corpus must remain intact and you can only spend the principal. An example of this would be like a cemetery. If you have monies that are set aside for a cemetery, they'd go into a permanent fund. Proprietary funds include our enterprise and internal service funds. Enterprise funds are funds that operate more like a business, where you're charging a fee, and typically there's debt associated with that, or there's the requirement to recover all of the costs through the fees. Typically, your utilities are set up that way, where you want to collect fees to offset the costs of operating that. Internal service funds, this is where you're allocating costs to various places within the organization, and typically internal service funds are used for things like insurance, where you're paying an insurance carrier for insurance that impacts the entire organization, or health insurance we typically see in the internal service fund as well. Fiduciary funds are where the government is acting as a trustee. The most common type is the pension trust fund. Again, to the extent you're involved in INPERS, you would not report a pension trust fund. You would just report that you're a participant there. But if you had your own sheriff's fund, you would have to then report the assets that are in that fund. Investment trust, private purpose, agency, these are all other fiduciary funds, basically where you're holding assets in a trustee capacity, and it's not for the use of the government itself. So when we prepare our basic financial statements, there's two distinct vantage points that we're trying to achieve here. With the fund financial statements, we're looking at the current operating cycle. So the focus is on what happened in the current cycle, how did we do relative to the revenues that we received in the current cycle. On the government-wide financial statements, we're looking at the long-term view. So how many assets have we accumulated? How much debt have we accumulated? Where do we look at, how do we look from a long-term perspective? And in the private sector, or companies that are traded on the stock exchange, this is what everybody looks at, is the long-term view. Sure, there's earnings per share and there's current reporting, but every entity that reports in the private sector, has to have financial statements that are full GAAP, they're full accrual. Then I mentioned reconciling the funds to the activities. Again, this is a reconciliation that's required in the GAAP financial statements. And then we also have this concept of aggregation and consolidation. I mentioned a little earlier about aggregating various similar funds that are together. We want to have a situation where we can have a summarized report that includes all the activity of the entity. Back years ago, they used to call this pyramid reporting, where at the very lowest level, you'd have all the individual funds. And then as you move up the pyramid, you would have combining funds. And then at the top of the pyramid, it would be combined by the major fund type. So that's how all of our funds would accumulate. And then combining that with the government-wide financial statements, that would give us our complete set of financial statements. Okay, I mentioned the reporting entity and component units. I think this is going to be new for a lot of people, so I wanted to focus a little bit more time on this area. The primary government, all the counties are primary governments. They have their own separate legal status, and they have their own elected governmental body. So, they can levy taxes, so they're considered a primary government. Where it gets to be tricky is what component units need to be included with the primary government's financial statements. So first off, what is a component unit? Well, it's a legally separate organization that's not a primary government. It could be another government, it could be a not-for-profit, or it could even be a for-profit, depending upon the relationship this component unit has with the primary government. In its most simplest form, if there is a organization out there that is serving exclusively the primary government, and we control that organization, it kind of makes sense then that that organization should be brought in to the reporting entity and reported along with the financial results of the primary government. But there's so many different organizations out there and so many different structures that the Governmental Accounting Standards Board had to come up with specific rules on how to measure these component units and how to evaluate whether or not they should be included within the reporting entity. So, I I already said it's a legally separate organization, and the PCU, or the potential component unit, if they are fiscally accountable, then it becomes a component unit. Well, so what does that mean? Well, there's these tests that the Governmental Accounting Standards Board has developed. If it is fiscally dependent and it presents a financial burden or benefit, then it should be included. So fiscal dependence means if the primary government approves the budget, approves the tax levy, or issues debt, or has the ability to set the rates, then the component unit is fiscally dependent on the primary government. As far as financial burden goes, benefit burden, if the primary government controls the assets of the potential component unit or is obligated to fund the deficits of this outside organization, then it's considered a financial burden or benefit, then it's a component unit. Another test is the board appointments. So if the primary government appoints the majority of the potential component unit's board, then it's considered to be a part of the primary government. Now, this is where it can get tricky because board terms usually change. Some might be, over one period or another. Whether or not we have a voting majority is sometimes difficult to measure. Another factor to determine is, does the primary government have the ability to impose its will on the component unit, on the potential component unit? So this means, can the primary government remove board members? Can they modify the budget? It sounds a lot like, fiscal dependency. Can they override the decisions of the component unit's board? If any of these are present, then the component unit has to be reported in with the primary government. Okay, so those are the tests we apply, but then there's one more category where the component unit doesn't meet any of the criteria I just mentioned, but it wouldn't make sense to exclude them from the financial statements of the primary government. And the prime example of this is in the higher ed space. Most universities, most public universities, have a nonprofit foundation that is a fundraising arm. And the nonprofit foundation is fiscally independent, so it doesn't meet the dependency criteria. They have their own board, and the university cannot add or remove board members. Typically, they have no debt, but there's, if they did, it would not be the responsibility of the primary government. And, we have no ability to impose our will. But this particular organization is raising money for one purpose, and that one purpose is to fund the university, to fund the primary government. So even though it doesn't meet any of the criteria that's been spelled out by the GASB, it's still included as a primary government. So when you pick up Purdue's financial statements on a GAAP basis, it'll have the results of the university itself, and it'll have all of its component units, the foundation being one of them. So that's a big change for a lot of us. We need to think about how the reporting entity is structured and make sure we're picking up all of our component units. I want to talk just a little bit about revenue recognition in the governmental funds. Now, the governmental funds are on the modified accrual basis of accounting. So they're going to look at near-term revenues. This includes property taxes, refunds, and another concept is deferred inflows of resources. So when we recognize revenue in the governmental funds, it's basically based upon when the transaction occurred. So with property taxes, it's kind of tricky because typically it's based upon the lien date, but we may have a case where the property taxes are intended to finance a different period, where they're intended to finance a subsequent period. So you may collect a lot of property tax dollars, but they're not recorded as revenue during the current period because they're intended to finance a subsequent period. And so that amount we call deferred inflows of resources. Sales and income taxes, excise taxes that were talked about before, all of those are based upon when the transaction occurs. So when did the underlying event occur that created the tax? That's when it should be reported in our financial statements. As far as expenditure recognition goes within the governmental funds, we're going to recognize a liability if the expenditure is expected to be liquidated with current available financial resources. So what does that really mean? Our normal recurring expenses, stuff like employee salaries, professional services, supplies, utilities, all the normal operating expenses are things that we're going to be expected to be liquidated with current financial resources. In other words, expected to be liquidated within the next, let's say, 30 to 60 days. So things that are not reported in governmental funds, liabilities to watch out for is what we call them, debt. The only thing that gets reported in the governmental fund with respect to debt is the current payment that's due, current principal and interest payment. All of the other debt gets reported out there in the government-wide financial statements. OPEB, other post-employment benefits and pensions. Again, both long-term liabilities, and both of those are just reported outside of the governmental funds. Those are reported in the government-wide financial statements. Leases with scheduled rent increases, and then certain other things are all just reported in the government-wide financial statements. Also, within the fund financial statements, we have this concept of other financing sources and uses. So to the extent we issue long-term debt, we're getting cash in, that would be reported as an other financing source. And we report that at the face value, so any premium or discount is netted against, is reported separately. If we enter into a new capital lease, we record that as proceeds in the other financing sources. We can also have transfers, where we transfer amounts from one fund to another. That gets in other financing sources and uses. So just to summarize, your assets and liabilities in your governmental funds are going to be all of the current assets in the organization. So certainly cash and demand deposits and similar financial assets are going to be reported in the governmental funds. Property tax and tax receivables will be reported. Inter funds, inventory, Assets acquired for sale. This is not very common, but let's say you acquired a condemned property and with the intention of turning it around to sell it. This is one instance where a capital asset would be included within the governmental funds. As far as the liabilities go, I mentioned accounts payable and accrued liabilities, tax anticipation warrants, any other liability that's liquidated with current resources is going to be reported within the funds. So now I want to talk about the governmental fund financial statements just a bit. And the focus of our financial statements is on the major funds. And there's a formula to determine which funds are major. I'm going to go through the details of that. There's a 10% test and a 5% test. And then also government officials' judgment plays into the calculation here. But one of the things that can impact what's considered a major fund or not is what I spoke of earlier with the fund aggregation. Because if we have 100 drainage funds, none of them individually would be considered to be a major fund. But once we combine them, it's possible that one of them, that the combined fund may reach the threshold and actually become a major fund. So just to chat a little bit about how major funds work, if an individual fund, first off, the general fund is always considered major, so it always has its own column within the governmental financial statements. In addition to the general fund, any other fund that meets the 10% and the 5% test, so if the assets, liabilities, revenues, or expenditures is greater than 10% of the total, and the total of the assets, liabilities, revenues, and expenditures are greater than 5% of the governmental and the enterprise funds combined, then it's considered a major fund. So again, using my example earlier, with the individual funds, it would never meet one of these tests, but by combining them, we may have a fund that actually reaches the threshold. And I'm just going to stop here for a second and talk for a minute about Allen County, because Allen County already produces a GAAP financial statement. And we've reviewed those statements, and they're in very good shape. And if you're looking for an example to use, anybody from Allen County here, by the way? Theirs is well, congratulations. But theirs is a great example of what a set of GAAP financial statements should look like. But one of the things about that financial statement is if you look under what they consider to be major funds, they have their general fund listed, and then they have several other funds that meet this 10% and 5% test. But then they have a whole bunch of funds that are aggregated into the non-major category because individually they don't meet any of this criteria. And so a good deal of the assets and liabilities and revenues and expenses are aggregated in the non-major category. So there's not a problem with that. It's just the level of detail that's provided, and the auditor's opinion covers only those major funds. So I'm going to cut it off here, and I'm just going to stop by saying this is a huge project, and if you haven't already started, you need to get started soon. As was mentioned earlier with the fixed assets, accumulating the information on fixed assets, getting the records together, making sure that your books are in order, all of that is a huge project, and that's just with respect to fixed assets. When we talk about full gap reporting, we need information on every debt issue, we need information on payables, receivables, all of the other assets and liabilities that make up our financial statements. It's a good idea to get started now and develop an opening balance sheet. So one of the things, if you're a county, you have until 12/31/19 to have this implemented. So it sounds like a long way away, but when you implement, you have to update the beginning balances for 12/31/19. Well, what are the beginning balances for 12/31/19 are the ending balances at 12/31/18. So that's only a couple weeks away, and you really need to start working on what those opening balances look like. Again, it's an important part of what's going on in the state. The investors, the investment community is looking for this type of information, so it's very important. Many other governments throughout the country report in this fashion, so it's really a good idea to get on board. I left up my email address is in there. If anybody needs help, feel free to contact us. We're going to be working with the state board and assisting them in putting on more sessions with more detail about HEA 1009. So thank you all, appreciate it, and good luck.